How do you pick in this environment?
Well, first of all, it's only January 14th, and we've got a long way to go to get through the rest of the year. And what I think investors need to consider is that there's this first 3-month period where we're going to get a lot of news on the political front. We're going to get a lot of news on the fiscal front. But then we still have to look at the second quarter, third quarter, and fourth quarter, which is when we expect the recovery to actually take shape. And that's when it becomes much more of a sector picking game, a stock picking game, and you have to be careful about what you're exposed to. And I think one of the biggest things that I want investors to remember is that consider what will change permanently post-pandemic and what was just a temporary phenomenon.
So what sectors are changed permanently post-pandemic, and which ones are just seeing a temporary boost or decline?
So we'll start with tech, because I think tech gets a lot of airtime, but it's worth it. So let's clear some things up. First and foremost, you don't go backwards in technology. So the things that got accelerated in this crisis are here to stay. Things like the digitization of society and what I would call contactless consumerism, all the things that changed about the way that we consume goods and services are probably here to stay. And then there's that whole trend of what we're calling de-densification. So the movement out of highly populated areas into more spread out areas. That drives things like autos. It drives things like home building and all the material sectors. And then there's the expectation of infrastructure spending, but it's a blue wave infrastructure spending. So that's going to drive clean energy. It's going to drive jobs in those sectors. And it's going to drive just the growth overall of different parts of the economy, middle class, lower class, and hopefully the labor market as well.
So I know you say the investing horizon that people should look at is 900 days as opposed to 90 days. But in that 90, 100-day range, we are expecting a lot of big developments, trillions of dollars in fiscal stimulus, and also potentially an infrastructure deal. So how do people play those first 90, 100 days?
Yeah, a fair question. And the reason I want people to focus on that longer term is because you can get really caught up in emotions in the short term. But in this shorter term period, that 90 to 100-day period, what it's going to do, or what we would expect it to do, is just really intensify the trends that were already in place starting back in November. And that was the cyclical trade. That was the reopen trade. That was the expectation that the economy at some point in the near future can start to stand on its own 2 feet, and we don't have to rely as much on policy. But this first 90 to 100 days is really to make sure that we can still bridge that gap for consumers, keeping consumers solvent, keeping small businesses solvent because they employ such a big portion of our overall economy, and making sure that the economy can get to the other side of this, particularly in the labor market. So watching that from a market perspective, we would still expect things like small caps to do well here. We expect international equities to do well here, Asian EM to do well here, and then sectors like industrials, materials, consumer discretionary, particularly in the spots that haven't been able to pick up yet, and looking at things like real estate and commodities that would participate in a reflation trade.
Shepard Smith here. Thanks for watching CNBC on YouTube.